Hey everyone, welcome back for another deep dive. Today we're tackling a topic that honestly can seem a little intimidating at first: stock analysis.
Yeah, I get it. Looking at stock charts and all that financial news, it can feel like you need a secret decoder ring sometimes, right?
Right. But here's the thing. Understanding this stuff, it's like getting this behind the scenes look at how the financial world works. And that's what we're doing today, diving into excerpts from stock analysis, different methods for evaluating stocks.
Yeah.
Hopefully by the end of this, you'll feel a lot more confident about making those investment decisions.
Exactly. Knowledge is power, right?
Yeah,
Especially when it comes to your hard-earned money.
absolutely. So let's get right to it. What exactly is stock analysis? I mean, in the simplest terms.
Well, think of it like being a financial detective. You're using data clues to investigate a company, a sector, even the whole market to understand where things might be headed.
Okay, so it's like we're trying to predict the future of a company, but instead of a crystal ball, we have data.
You got it. And at its core, it's all built on this really interesting assumption, this idea that hidden within all that market data, the true value of a stock is just waiting to be discovered.
Okay, so it's like we're on a treasure hunt for hidden value. I'm
Oh.
into it. Tell me more about how we find this treasure. What are the tools of the trade?
So imagine you have two different maps to guide you on this treasure hunt, right? That's essentially what the two main approaches to stock analysis are, like two different ways of looking at the same thing.
I'm intrigued. The article calls these approaches uh, fundamental analysis and technical analysis, right?
Yes, and they're kind of like two sides of the same coin. Fundamental analysis is all about looking under the hood of a company, diving deep into their financial statements, their assets, their market share. You're basically getting this 360-degree view of their financial health.
Got it. So it's like we're doing a deep dive into the company's DNA. We want to understand everything that makes them tick.
Exactly. You're trying to figure out if the company is fundamentally sound. Now, technical analysis takes a different approach. Instead of focusing on the company's internal workings, it focuses more on its stock's price history and trading patterns. Think of it like studying charts and graphs to identify trends, almost like a meteorologist tracking weather patterns.
Oh, I see. So if fundamental analysis is like reading a company's biography, technical analysis is more like looking at its social media history, right? Trying to see what it's been up to and where it might be going.
That's a great way to put it. And just like with anything else, both approaches have their own strengths and weaknesses.
And we're going to delve into each of them because I'm already thinking, okay, when would I use one approach versus the other? What kind of clues should I be looking for?
Absolutely. We'll break down each approach, explore the key concepts, and yeah, we'll discuss when one might be more suitable than the other. It all depends on what you're looking for, really.
This is getting exciting. Okay, so for everyone listening, think about which approach kind of resonates more with you right now, diving deep into a company's financials or trying to decipher those patterns in the stock charts. Hold on to that thought because we're about to explore both of these fascinating approaches in detail.
All right, ready to put on your analyst hat and really dive into this world of fundamental analysis.
I'm ready. But gotta be honest, the thought of actually like going through financial statements, I kind of feel lost already.
Yeah, I hear you. It can be a little overwhelming at first, but think about it this way. Think of financial statements like a company's autobiography.
Mhm.
Each statement tells a different part of their story.
Okay, I like that analogy. So we've got these balance sheets, income statements, cash flow statements. What kind of stories are they telling us?
So let's start with the balance sheet, right? That's like a snapshot. It shows you what the company owns, right? What they owe to others, and then the difference, that's the value that belongs to the owners.
Okay, so it's like a financial checkup, basically. Are they in good shape, or are there some red flags?
Exactly. And then you've got the income statement. This one tells you how much money the company made over, say, a year, how much they spent. Did they end up with a profit?
So it's like revenue minus expenses equals profit. Sounds simple enough.
There you go. And then there's the cash flow statement, which some would argue is the most important of all
Hmm. Yeah, I've always heard cash is king. Why is that?
because it shows you the actual money, right?
Yeah.
Coming in, going out, which is it's more tangible, right? More than just looking at profit on paper, because a company might look profitable but still struggle to, pay its bills if they don't have good cash flow.
That's a really good point. So we've got these three statements, but you mentioned comparing them over time. Like, why is that so important?
Imagine, reading just one chapter of a book, right? You get this glimpse of the plot, but you're missing the whole story. Same with these statements. Looking at them over time lets you spot trends, how that company's story is unfolding, and that helps you make a better guess about the future.
So instead of a snapshot, we're watching a movie.
Exactly. We can see, are they growing? Are they struggling? Are they taking on more debt?
Are they becoming more efficient with what they're doing?
Precisely. And to make sense of these numbers, to dig into the nitty-gritty, analysts use what are called financial ratios.
Ah, yes, ratios. Flashback to high school math class.
Don't worry, it's not as intimidating as it sounds. Ratios help you quickly size up a company's financial strengths and weaknesses. It's about comparing, different line items from those statements.
So it's like we're finding the story behind the numbers, right? By comparing them in different ways.
Exactly. Let's take the current ratio as an example. That's something that's mentioned in the article. This ratio tells you if a company has enough short-term assets to cover its short-term liabilities. So basically, can they pay their bills, right? A healthy current ratio, usually above 1, means a company is unlikely to face, a cash crunch anytime soon.
Got it. Got it. So if I see a company with a current ratio of like zero point 0.5, that's a red flag.
Could be a red flag, yeah. They might have trouble paying those bills coming due. Another important ratio is this debt-to-equity ratio. It tells you how much debt the company is using to finance its operations compared to its equity.
Right, because the more debt a company has, the more vulnerable they are if things go south, right?
Exactly. But it's all about context, right? A high debt-equity ratio might be totally normal for some industries, like utilities, where they have those big investments in infrastructure.
So you got to compare apples to apples, right? Look at the industry averages, what they've done in the past to really get the full picture.
You got it. And that brings us to another key aspect of this whole fundamental analysis thing. You have to understand the playing field.
Because a company doesn't exist in a vacuum, right?
Yeah.
They've got competitors.
Exactly. You can't just look at the numbers in isolation. You have to compare them to their competitors, see how they measure up, market share, their profitability. How are they growing compared to everyone else?
It's like scouting out the competition before the big game. Who are the major players? What are their strengths and weaknesses? Where does this company fit in?
That's a great way to put it. It's about understanding the whole industry, right? What are the potential threats? Where are the opportunities? And ultimately, does this company have what it takes to compete?
Okay, this is all starting to make sense. So fundamental analysis, it's about becoming a detective, basically, of the company's business. You're putting together the clues from their financials, their industry, to kind of make a judgment about their value. Are they a good investment or not?
Precisely. But remember, that's just one side of the coin. We've explored this world of balance sheets and ratios and all that. But now get ready for a change of pace because we're shifting gears into the world of charts and trends with technical analysis.
Okay, so we've explored this whole world of balance sheets and ratios with fundamental analysis, but now it's time to break out those crystal balls because we're talking about technical analysis.
Well, not exactly crystal balls, but we are going to be looking for patterns and signals, and all from the historical data.
So tell me, how can you predict the future just by looking at these squiggly lines on a chart?
Right. That's the million-dollar question. Technical analysts, they believe that those squiggly lines, they hold these valuable clues, right, about market sentiment, about where the price might go next. They look for recurring patterns, trends, anything that might suggest where a stock's headed.
Okay, so like what kind of patterns are we talking about here? Give me an example. What's something specific that a technical analyst would look for?
One key concept is what's called support and resistance levels. Think of them like floors and ceilings for a stock's price. So support, that's the price level where a stock tends to find some buying interest and then bounce back up. Resistance is kind of the opposite. That's where selling pressure kicks in, and that kind of prevents the price from going higher.
So it's like this tug of war between the buyers and the sellers and these support and resistance levels. That's where the two sides are battling it out.
Exactly. And you can often identify these levels by looking at previous highs and lows on the chart. Like if a stock breaks through a resistance level, that's often seen as a really bullish signal, right? There's enough momentum to push that price even higher.
That makes sense. But aren't there like a million other things that could impact a stock price beyond just, what it's done in the past?
Of course. And that's one of the biggest criticisms of technical analysis, right? Relies on historical data, assumes that those past patterns will repeat in the future. But we know the market is influenced by everything. I mean, you've got economic news, political events, technology, even just changes in consumer behavior.
Right. So like a surprise earnings announcement or just a sudden shift in how people are feeling, It could throw off even the most, like, well-established patterns.
Exactly. It's like trying to predict the weather. You can make an educated guess, but sometimes those unexpected storms roll in. That's why it's so important to remember. No form of analysis can predict the future perfectly.
That's a really good point. So if technical analysis is just one piece of the puzzle, then what are some of the other methods that analysts are using to get an edge, so to speak?
Well, we talked about analyzing a company's financials, we talked about studying these market trends, but another really fascinating area is what's called sentiment analysis that focuses on gauging public opinion. How are people feeling about a particular stock or even the whole market?
Sentiment analysis. So you're talking like tapping into the mood of investors. How
Yeah.
do you even measure something like that?
Well, it involves a lot of data, right? News articles, social media, blog comments, online forums. Analysts, they look for trends in all of that. Like, are people generally positive or negative?
It's like they're taking the pulse of the market by like eavesdropping on what everyone's saying online.
Yeah. And then there's quantitative analysis, which is even more data-driven, uses complex mathematical models and algorithms, all to try to find those trading opportunities.
That sounds incredibly complicated.
It can be. These quants, as they're called, those are the mathematicians of the financial world.
Wow. It seems like there's this whole universe of stock analysis out there, and each method, it's like offering this different lens through which to kind of view the market.
That's a great way to put it. And the best investors, they don't just rely on one method, They take bits and pieces from all of them.
So it's not about finding like the one right method. It's more about like understanding how they all work together.
Exactly. It's about being adaptable, staying curious, and always learning.
Well, this has been an incredible deep dive. We've covered so much, from those nitty-gritty details of fundamental analysis to the world of charts and trends with technical analysis, even touched on those more advanced concepts like sentiment analysis and all the quant stuff. So much good stuff.
It's been a pleasure exploring these topics with you. Hopefully, our listeners are feeling a bit more confident about navigating this world of stock analysis.
Absolutely. And for anyone listening, remember, whether you're, seasoned pro or just getting started, the key is to stay informed. Don't put all your eggs in one basket and never stop learning. Until next time, happy investing, everyone.